Patti Ogilvie, and I'm with the Student Loan Help Group. I'm a senior enrollment counselor here.
And my name's Sam Pettingill. I'm also a senior enrollment counselor here at the Student Loan Help Group.
So today we're going to go over about income-driven repayment account adjustments, and discuss some of the changes in 2023, as well as some other information that you guys are all going to find helpful. So Sam, let's start out with a simple question. What's the income-driven repayment account adjustment?
So this is a program the Department of Education announced back in April of last year. It's a temporary modification to the requirements of IDRF and PSLF. They've been kind of modifying it as they go along. They actually just recently extended the deadline. It was originally supposed to be in May of this year. So they've continued to make little modifications as they go along, but it's a really exciting program for a lot of borrowers because it's going to get most people much closer to forgiveness. So the main things that it's going to do, if you're set up correctly by the deadline, which right now is set at the end of this year, you'll receive additional credit to two different programs, assuming that you're qualified for them. So one is income-driven repayment forgiveness, or IDRF. The other is PSLF, public service loan forgiveness. That's the program for borrowers who might be working for a government or nonprofit employer. So with this one-time account adjustment, you'll be able to receive additional credit toward both of those programs that normally would not qualify. So for example, if you were in forbearance for an extended period of time, that's something we see a lot of borrowers struggle with, that maybe once you first graduated and you weren't making as much as you were hoping, and you weren't able to make the payments on, say, the standard payment on your student loans, you might have gone into forbearance. And sometimes we see borrowers who have been in forbearance for extended periods of time. This is something that the one-time account adjustment is going to address. It's going to be able to give you back credit for that time. So the new things that will be able to count, as long as you're set up correctly by the end of the year, are any months in a repayment status, regardless of the payments made, meaning whether payments were made or not in that particular month, regardless of the loan type that you had, and regardless of the repayment plan that you were on. So even if it was a non-qualifying payment plan, you'll also receive credit for any month in which your loans were in an eligible repayment, deferment, or forbearance status prior to a consolidation. So normally speaking, if you consolidated your loans, say 5 years ago, that's where the Department of Education starts counting for forgiveness programs. Nothing before that would count. With this one-time account adjustment, if you've consolidated in the past, it is not going to hurt you. You're still going to receive credit for the entire eligible period, even if there were several consolidations in there. You're also going to be able to receive credit for months when you spent at least 12 consecutive months in forbearance, so at least 12 months at one stretch, or if you spent 36 or more months in cumulative forbearance. This is not counting the time that we received during the CARES Act forbearance because of COVID-19. That forbearance qualifies no matter what. But if you're one of those borrowers who had maybe 5 years off and on in forbearance over the last 15 years, that forbearance time, all of those 5 years, is going to count, even if it was in small chunks. You'll also be able to count any month in deferment, with the exception of the in-school status and in-school deferment itself. So if you were in deferment for any reason other than continuing your education before 2013, that time is going to count as well. Also, certain deferments after 2013, it's not actually part of the one-time account adjustment, but for example, economic hardship and cancer treatment, military service deferments, those are now qualifying as well. So even though that's not part of the one-time adjustment, that's another benefit that's happening now for borrowers.
So, you know what, Sam, we probably should point out that it's really important that they take advantage of this while they can, because this week, we just crossed over $168 million in forgiveness so far for the people that we've helped. And majority of them are people that are taking advantage of this limited time for this one-time account adjustment.
Absolutely. I think I've lost count even just this week, because we're starting to see the first wave of IDRF forgiveness come in. So many people who have received forgiveness on loans that they've had for 20, 25 years or more. So
it's been incredible.
Exciting. So yeah, that kind of touches on the next thing we were going to talk about. I mean, has the account adjustment already started?
So yes, the first batch of PSLF forgiveness, that's public service loan forgiveness under the one-time account adjustment, they started to see those coming through January 2023, and over 800,000 borrowers received notice on July 2023 that they were eligible for discharge under the IDRF. That's the income-driven repayment forgiveness. So it has been life-changing for so many people. The DOE, they'll continue to send out notifications to borrowers who reach the necessary forgiveness thresholds every 2 months until next year. And then at that point, all the borrowers who are not yet eligible for forgiveness will have their payment counts updated. And then next year, the Department of Education expects to have a payment tracker for IDRF on studentaid.gov, which is really important because up until now, there's been no place to see how close you're getting. And then, again, not to, repeat ourselves, but this isn't going to happen automatically if you don't take the necessary steps to get your forbearance and get the loans corrected and so forth. So there are some steps to take. So don't just sit back and expect that it's going to happen without any initiative on your part. That's not how it's going to be at all.
Exactly. There's a small group of people who will see, like, just because they happen to be set up automatically, we'll see it happen, but that's such a small group of people, it's not worth taking a chance.
Exactly. And then Sam, who's going to see their loans discharged entirely?
So that would be borrowers that, because of this adjustment, have now reached the necessary thresholds for the program that they're going towards. So for borrowers in public service loan forgiveness, that's borrowers who have reached 120 qualifying payments, and a qualifying payment has to be made after October 1st of 2007. So even if you've been in public service since the 90s, it's only months after October 1st of 2007 that they'll be looking at. But with these expanded requirements, the majority of your payments during that period of time for most people are going to be able to count. And then for borrowers in IDRF, income-driven repayment forgiveness, it's a little bit different. Instead of 120 qualifying payments, their requirement is 240 or 300 qualifying payments. But they also go back much further. So instead of 2007, they'll be looking back to July 1st of 1994. That's the first date they can consider. The difference between the 240 and 300 depends on the type of loans that you have, what they were for, and what repayment plan you were on. So the borrowers who would need 240 qualifying payments, those would be borrowers with only undergraduate loans or loans that are on the pay-as-you-earn or payee repayment plan. Now, from what we understand, if you have a mix of graduate and undergraduate loans and you have not consolidated them, the graduate loans will be on a different threshold than the undergraduate loans. If you have consolidated your loans all together and you have a mix of graduate and undergraduate loans in the same consolidation, then you most likely will be in the 300 category. Even if you have one graduate loan in there, it's going to push you into the 300 qualifying payments needed. So anyone with graduate loans, the graduate loans themselves, or any consolidations with graduate loans in them, that's the 25-year period, as well as borrowers that have Parent Plus loans. That would be if you have, you're on the ICR repayment plan because you borrowed on behalf of a child, then that will also be the 300 months. So definitely, if you've already been in repayment for a while, this is the time to get on track, because chances are you may already be either closer to forgiveness than you think, or maybe even already there.
And then about the IDRF, it doesn't matter who you're employed by, or even if you are employed, and that's that's a big difference between that and PSLF.
Yes, that's a huge difference. IDRF, basically everyone qualifies for IDRF. The only time you would not qualify is if you had the wrong loan types, and those are things that are correctable. So even if you're not working or you're retired, you can still qualify.
Right.
So Patti, how can borrowers qualify for the adjustment if they don't already?
So for public service loan forgiveness, PSLF, borrowers with any FFEL loans, and that stands for Federal Family Education Loans, Perkins loans, or the HEAL, that stands for Health Education Assistance Loans, those loans must be consolidated into direct loans before the end of this year in order to take, advantage of that one-time account adjustment. And then for IDRF, income-driven repayment forgiveness, borrowers with the same commercially held FFEL loans, Perkins loans, or the HEAL loans must also consolidate to direct loans before the end of the year. So these are really important steps. And if you miss that window, you'll still be eligible for these programs. But the difference is that you will still have to get set up correctly, but you will be starting at payment number 1. None of your past time is going to count.
Exactly. And that's especially important for PSLF, because IDRF, certain FFEL loans can qualify. PSLF, no FFEL loans can qualify. So if you happen to have a mix of 2 different kinds of loans or something like that, you definitely need to make sure you're getting those taken care of.
Right. And then Sam, why are payments being recounted with the new IDR waiver?
So actually, this program came about because the current administration is trying to address historic inaccuracies in the count of payments that qualify for forgiveness under both of these programs. PSLF and IDRF have both been around for 15 and 25 years. They're long-standing programs, but something a lot of people have found is a very small number of people actually receive them. My understanding with IDRF is it's been, under 10,000 borrowers up to this point, before all this had started, that had actually received forgiveness. And with PSLF, the rejection rate every year has been around 98%. So they've done a very bad job of making sure people who should be able to qualify actually do qualify because of technicalities. The other problem that they've had is practices that the loan servicers themselves, so the company that is administering your student loans for the federal government, some of the loan servicers were not following the Department of Education's rules. They were actually violating the guidelines that they were given. That's most noticeable in a practice that the DOE calls forbearance steering. A lot of borrowers have experienced this. Maybe you're going through a little bit of financial difficulty. You call your servicer and you say, hey, I'm struggling with my payments right now. I can't afford this. The servicer should be offering to put you on an income-driven payment plan, because a lot of borrowers do qualify for $0 payments. That would count toward forgiveness. That would let you keep making progress. Instead, what a lot of the servicers did was say, hey, would you like to have some forbearance? You won't have to make payments for a year. And then a lot of times, borrowers will say yes. The problem with that is that during that forbearance time, you're still having interest accrue on your loans, but you're not making any progress toward forgiveness. So it's a win-win for the servicer because they're still receiving profit from your interest, but it's really losing out for the borrower because you're not making progress to getting your loans dealt with. You're actually just seeing your balance go up. So as a result of those past failures, a lot of borrowers who should have qualified for IDRF or PSLF are finding themselves unable to receive forgiveness, even after making payments for 25 or 30 years.
Yeah.
So that's really what this is meant to deal with. And so far, that's exactly what we've seen it doing. It's working exactly as intended. It's helping those people get forgiveness. So,
Right.
So Patti, which student loans can this adjustment end up being applied towards?
So any direct loans or federally owned FFEL loans, and that again stands for Federal Family Education Loans. And then note that borrowers going into public service loan forgiveness program must consolidate all FFEL loans for them to qualify, not just those that are not federally owned. So what that means is your loans that are FFEL loans need to be consolidated while this one-time account adjustment is still in place before the end of the year. And then once the DOE goes back in and does a qualifying payment count, depending on which program you're going towards, then your loans are going to pick up the qualifying payments from all those loans, even though right now they're not eligible. They will be eligible after they're consolidated and turned into direct loans.
Yes. And one thing I did want to mention too, Patti, because it's not here anywhere, but it is kind of a special case that applies to a lot of people. Even if you don't have FFEL loans, even if all of your loans are already direct, if you've taken your loans out at several different times,
Yep.
then you went to grad school in 2010. This one-time account adjustment gives you a unique opportunity to consolidate those direct loans together, and they will also pick up the payment history of the oldest loan in the consolidation. So I've seen borrowers where they had 1 or 2 loans back in 1993, they consolidated them with brand new loans from 2020, and those loans from 2020 end up being forgiven along with the old loans based on the payment history of the old loans.
Yeah.
So if you went to school at several different times, even if you already have all direct loans, make sure that you're taking a look and taking advantage of this, because that is a shortcut to forgiveness for a lot of people.
It's been huge. A lot of people who have Parent Plus loans, for example, for their children, not everybody, it's not the right choice for everybody, but best to let us take a look. But they were able to include the Parent Plus loans in the consolidation and get those also forgiven with, PSLF or IDRF. Again, don't just jump in and do that, because there's some crazy little caveats with the Parent Plus loans, but still that could be a possibility as well.
Yes.
And then what can borrowers expect on the road ahead, Sam?
So there's a lot more exciting changes. I mean, we've already covered some really great positive changes, but there's even more coming. The Department of Education has already published regulations for more changes to PSLF and IDRF that are taking effect next July 1st. July 1st is usually when the DOE has their rules taking effect. So already announced is that beginning next July 1st, if you happen to be on the new repayment plan that was just announced called SAVE, or Saving on a Valuable Education, that just came out about a month ago on July 30th. If you're in that plan beginning next July 1st, you can be eligible for forgiveness under IDRF, the income-driven repayment forgiveness, much sooner. If your original principal balance on your loans was $12,000 or less, those loans will receive forgiveness of any remaining balance after making 10 years of payments. So 120 payments, just like PSLF, as opposed to the 240 or 300 payments. Additionally, if you, let's say you didn't quite borrow 12,000, maybe you borrowed 14,000 instead. The maximum repayment period before forgiveness happens rises by 1 year for every additional $1,000 borrowed until you hit that maximum of 20 years again. If you hit 240, it's not going to go above that.
Right.
Let's say in that example, you borrowed $14,000 original principal balance. You'll see forgiveness after 12 years. So this is kind of giving like a little bit of a, I don't know really what to call it, like a little bit of an on-ramp for forgiveness for the people
Right.
who maybe didn't borrow quite so much. And if you only borrowed $7,000, 20 years of payments is a really long time. This is going to be reducing it down to 10. This will also count in those payments. It will count payments made before 2024, as well as the payments made going forward. So with the one-time account adjustment, if you didn't quite reach the threshold that you need, it's not going to disappear. I actually spoke with somebody yesterday that had 145 qualifying payments for IDRF, and she had a balance that was under the $12,000 threshold. And next year, once that rule change takes effect, she'll see forgiveness on her loans. So that is really exciting that you're getting to keep those existing payments as well as count the ones that are made going forward. You're also going to be allowed starting next July 1st to make additional catch-up payments to get credit for non-qualifying periods of time. So let's say you went back to school in 2019 and you were in forbearance for 6 months. The Department of Education is going to have a procedure, deferment for 6 months. The Department of Education is going to have a procedure for you to receive credit for that time in deferment that normally would not have counted. Even with the one-time account adjustment, we know that wouldn't count because it's in-school deferment. This change is going to allow you to look back and receive credit for some of those prior periods as well. So that's pretty exciting too. That's something that's never been offered before.
It's amazing.
Yeah, it really is. So with all these changes, Patty, what are some of the dates people should have on their calendars for the remainder of the year so they don't miss anything important?
Yeah, definitely important. So September 1st, probably most people are aware that interest starts to accrue again and payments are going to they're set to resume again on October 1st. And so again, everybody's servicer will make that determination when the first payment is due, but for majority of people, it's going to be that October 1st date. And then, we're assuming this December 31st is the deadline to consolidate for the one-time account adjustment. But we've said this before, I would not trust that date because the DOE has not mentioned that date specifically. They just say the end of the year. Yep. So the sooner the better for sure, because again, the 31st, people are getting another opportunity that they had when the waiver was in place that expired on October 22nd. Don't expect that this is going to be extended or you're going to get any more chances. Yeah. Because it's not going to happen. This is it. This is your last chance to take advantage of all this that's going on right now. Wouldn't you agree, Sam?
I agree. And I mean, you also need to be aware there's been times in the past, like for example, when the Biden debt relief was announced, where they've changed those deadlines arbitrarily without giving any advance notice. Yeah. So with that program, we actually saw where they said, hey, we said that FFEL loans were going to qualify, but now we've decided that it only qualifies if you consolidated a week ago or sooner, and it doesn't qualify anymore.
Yeah.
So, it's kind of at their discretion what they want to do. It's important that you do it sooner rather than later, just in case anything does change.
Right. Because once anything is in their system with a date on it, then that's it. That's the date they're going to go by. Not, that it has to be done by the 31st. Everything has to be at least initiated before. Again, I don't want to say December 31st. Let's just say what they say, the end of the year. Does that mean October? Does that mean November? So the point is don't dilly-dally. And if you're not sure, set up a date and time with us. We'll take a look. We'll go over everything. We'll review your loans and see exactly what options you have. I think that is really the best bet because people get confused. And if you're not sure, just reach out to us. We're happy to take a look.
Yep, that's what we're here for. I mean, you'll have an expert one-on-one consultation, and we'll be able to go over all of your options and make sure that all your questions get answered.
Exactly. So do you have anything else that we should add to this, Sam, or you think that's enough info for today?
No, I think we've covered a lot of ground. This is, really important information for a lot of people.
Absolutely. So again, thanks for looking at our webinars or our recordings, and next one we'll give you some more great information. Thank you so much, y'all.
Have a great one.
Bye.